Mr. Rishit Kotecha, Chairman and Managing Director, Mr. Hiren Kotecha, Whole-Time Director, Mr. Kirit Dharavia, CFO, Mr. Jayesh Khagra, Group CFO. As a disclaimer, I would like to inform all of you that uh, as a disclaimer, I would like to inform all of you that this call may contain forward-looking statements which may involve risks and uncertainties. Also, this is a reminder that this call is being recorded. I would now request the management to detail us about the business and performance highlights for the period ended March 2026, the growth perspectives and the vision for the coming years, post which we will open the floor for Q&A. Over to the management team.
Thank you, Kamlesh for briefing the company details. I would like to thank you all the investor and our IR team and all our Madhusudan team. Good afternoon, everyone. Myself, Rishit Kotecha, Chairman cum Managing Director of the Madhusudan Masala Ltd. A very warm welcome to our Q4 and full year of FY26 earnings conference call. Before I begin, I want to thank our entire Madhusudan team, our channel partners, distributors, our advertising agencies. Our FY26 performance is the result of your passion, our hard work, and belief in our journey. Thank you. Now coming to the business update. First of all, our financial year 26 has been our strong growth and stronger our branded sales. FY26 has been excellent year. We closed with the total sale of 291 CR, which was last year 232 crore. And real story in our strength is branded sales, which is grown at a 40% YOY from 144.75 CR last year, FY25, and this year we have closed the branded sales to 203.88 CR. Today, 77.90% of our total revenue comes from branded sales, which was 66% in last year. This 11.25% basis point jump so that the Madhusudan is now firmly established as a consumer brand company. While I am talking for the category-wise leadership driving growth, our ground spices continue to be our growth engine, which is 64.4% grown from 54.60 crore to 89.75 crore. Now contributes 34% of our total company sale, while whole spices delivered 67 crore, other groceries scaled to 3 crore, and tea already doubled to 2.15 CR. We rationalized the branded sales to focus on profitability. Third is execution. Our team and market expansion with we have 101 sales team in dedicated sales team for entire Madhusudan umbrella, which is focused only on our branded business. While region-wise sales, Gujarat remains our home market as a 47% of branded sales, but our expansion playbook is also working, like Punjab, Chandigarh, and Delhi now contributes 12%. UP, Bihar, Jharkhand contributes 12%, while Maharashtra contributes 10.5%, and Jammu Kashmir also contribute more than 9 to 10% in our branded sales revenue. While talking about the brand-wise contribution, our Double RT brand is flagship, which continues to grow, and Double RT branded sale is more than 120 CR to 122 CR, making up to 60% of total branded sale, while 77 Maharaja and Mantavya are gaining rapid traction. In gram spices, chili leads with 65% value share, and followed by turmeric and coriander cumin powder. Fifth, our road journey ahead. For FY27, our focus is clear. We target to achieve 80% of branded sale deepen distribution in focus states, drive premium SKUs, and continue margin expansions. We will invest behind automation, food safety, and brand building. FY26 proved that Madhusudan Masala can scale profitability as a brand. FY27 will about the leadership. Let's now move to the presentation. Post that the management team and I will take your question. Thank you. Thank you so much. Over to management IR team.
Yes, sir, you can continue with the presentation.
Yes. As compared to last year, we have expanded our presence in some states like Bihar, Uttar Pradesh, and Jharkhand. Through these states are contributing smaller sales in entire segment, but we hope in this current year, FY27, we will continue get the growth from these newly added regions from this yeah, our branded sales. Next. Actual growth engine of our brand is like ground spices is our main growth category, and blended spices is value added category which grow our margins and profitability. We have added 21 more than 21,000 retailers in last financial year. 770 plus wholesalers, 120 plus distributors, and 15 plus super stockists. While we have added 2 states in our entire portfolio. Our mission is clear, and we want to grow our own brand sales, and for that we are gaining region-wise, region-specific ground spices. Like we earlier we have talked about that we want to serve. We are serving region-specific ground spices in specific region, like in Punjab or in Chandigarh. We are serving at particular ground spices taste. So this is our mission and vision. Next. Yes, this is our timeline history. Next. As a management, myself, Rishit, and my cousin, younger brother, Hiren Kotecha, led the company. Next. Some of our business strategy, like we regularly fight with the regional commodity players in a newly established region also, and existing region also. But we got also got the advantage of these regional players because they do not have quality specifications, or they do not have much more SKUs in their portfolio. So these qualities of our Madhusudan company leads us to easily acquire the distribution channel, retailers, and our super stockist channel, because we have a more than 500 plus SKUs in our umbrella. So any distributor or super stockist can easily convert to our Madhusudan umbrella. Next. Our business model is like we procure the raw material in restricted seasons, then store it in a particular cold storage. Then, as and when required, we do the manufacturing process like grinding and sieving as per batch-wise processing. Then product packaging, and later it distributed to distributors and super stockist channels. our product portfolio is in Madhusudan umbrella. There is three brands: Double Athi, Maharaja, and Mantavya. Double Athi is the entire product portfolio, while Maharaja and Mantavya is only ground spices portfolio. And our subsidiary Vitagreen product has a double seven green brand. And this double seven green brand has also entire product portfolio in the exclusive range of instant mix in double seven only. Our manufacturing process is very simple. There is no any much more rocket science in grinding the making the masalas. We just dry the raw material, then clean it and grinding and blending, then sieving and packing. This is a very simple method to manufacture spices. We have two manufacturing facilities. One is Jamnagar facility, which is 6,000 metric ton manufacturing capacity, which was last year 4,800 metric ton. And I am very happy to say that we are utilizing 99% of our capacity in this Jamnagar unit. Second is our manufacturing unit at Rajkot Metro GIDC, and total capacity is 600 metric ton, and we are utilizing 100% of capacity from this unit. And this unit is exclusive for manufacturing of blended spices and instant mix. Rest all other grocery products and ground spices being manufactured at the Jamnagar plant. And we are going to expand our Rajkot manufacturing facility, which is located near between the Rajkot and Jamnagar highway. Almost project is going under construction, and mostly we expected to commence production from September 2026, and so capacity will be 6,000 metric ton out of Jamnagar capacity. So from FY27, our combined capacity will be 12,000 metric ton. So this will also benefit to provide our product easily to newly launched regions, and also we want to launch some new products. So this will also help to launch our new products in this new facility. Some of our states which are currently operated. We expecting 30% of CAGR growth from next 5 years. Next. Our company is evolving as a FMCG brand. First, we dominant as a regional brand. Second stage, we expand our distribution channels. In third, we make competition with national brands and with pricing strength and margin expansion. And fourth, we want to expand our network pan India. So as a second and third stage, we are already deployed in our category. Some of the industry market outlook. Yes, these are the industry output. Like Indian spices market is 2.2 lakhs crore in 2025, which will projected to be reached 5.3 lakhs by 2034. Industry is growing by 10% of CAGR, and more interestingly, branded sales is growing by 26% of CAGR. So this transition of non-branded to branded will also benefit to Madhusudan. These are our financial highlights. If we exclude the extraordinary items from last year, our revenue grew 50%, almost 50%. EBITDA is grown 50% from last year, while our revenue is grown 33% YOY in quarter four, while in FY26 our revenue is grew by 26% to 291 crore, while EBITDA has been grown by 36% in FY26, which is almost 33 crore. And our margin is moderately improved because of our branded sale contribution has been increased. So margin was earlier below 11%. Now it has been increased to 11.3%. While profit after tax has been also increased to more than 50%, and it has been stood at 18.5 crore. So this only possible due to the increase in our branded sales. Product-wise, revenue is also interesting to I will interested to share with you. Like our ground spices stably growing with stands at 44%, while whole spices is also consistently growing at 33%, and other grocery products which is grown by significantly from 5% to 6% with newly added products like ginger garlic paste and other salts like black salt, pink salt in small SKUs. So this category has been grown by marginally, and this category has grown from 13% to 16%, and tea is constantly sales at double from last financial years. Total volume-wise bifurcation of our category, like ground spices has been stood at 44 and 64, while whole spices also at 56, and blended spices also growing. So continuously our branded sales are growing, and the led by the category of ground spices only. I hope our financial data has been reviewed by all of you, all of yours.
Thank you, sir.
Yeah.
We will move to the Q&A now. So all those who wish to ask a question may use the option of raise hand. If you're not able to use the option of raise hand, you may post your question in the Q&A section as well. We'll ask on your behalf. We'll wait while the question queue assembles. So we'll take the first question from the line of Miss Surbi Mishra. Surbi, you can unmute and go ahead, please.
Hello, sir. Am I audible?
Yes, you are audible.
So, I wanted to know the procurement and quality control are key strengths, like seasonal sourcing is around 80% amid spice price volatility. How are you managing raw material costs, and do you expect any margin pressure or benefit in the coming quarters?
Yes, sure. As our a regular practice, we procure our raw material in respected season, like 50 to 7 between 50 to 70%, as per the market scenario in and forecasting of crop data and export data. We procure our raw material in respected season, minimum to 50% and maximum up to 70%. So this practice give us the uh, gave to for the entire year to maintain the margin. If we get the forecasting of raw material for as a constant price, then we store at the 50% minimum ratio. And if we forecast, we get the forecasting of margin will be higher and the crop is lower from farmer side, and export will be also in good numbers. So we procure the raw material maximum up to 70%, and then 30% will be procuring in as per the price will be much lower or going much higher. We procure the material at 30% at the current price. So this process makes our margin stable. I think your question will be answered.
Thank you, sir. Surbi, do you have any further question?
Yes, sir. One more question. Uh, since you have added significant retailers, wholesalers, and distributors in FY26, reaching 15 states, what are the priority regions for FY27 and 28? Uh, can you tell us deeper penetration, which is in Maharashtra, Telangana, or North Indian states? What is the targeted distributor and retailer addition? Can you let me know about that?
Sure. Is Last year we have added more than 21,000 plus retailers in our portfolio. So in FY27, we are targeting to reach our retailer portfolio up to more than 70 to 75%, 75,000 by adding 100 plus distributors and 10 to 12 plus super stockists, because super stockists are region-wise, we are appointing the region-wise. So the super stockists give us 10 to 15 distributors, and each distributors provide us 40 to 50 retailers. So expecting this scenario, we are expecting that more than 75,000 of retailers and 500 plus distributors will be in FY27.
Thank you, Surbi. We'll take the next question from the line of Mr. Deepak Poddar. Deepak, you can unmute and go ahead, please. Hello, Deepak.
Yeah, I'm audible.
Yes, yes, you're audible. Please go ahead.
Okay.
If you can just come closer to the mic, I think you'll be better audible.
Yes. Yeah. Thank you very much for this opportunity, and many congratulations for a good set of numbers.
Thank
So
you.
just wanted to understand first of branded sales. I think currently we have 70%, right, in this year. So how should we look at the trajectory going forward in the next 2, 3 years? Where you want to take this 70% to?
As I already told that we are expecting this branded sale from 70% to 80% in 1 or 2 years. Maybe if our planning for specific region expansion is going fruitful, then we will achieve 80% of branded sales in FY27. But anyhow, we will achieve 80% till second half of FY27 is our 100% target.
No, 80% by when? Second half of
80%
FY.
by, lately it will by second half of FY28.
Next year. Okay. The second half of FY28. Okay.
Yeah.
And then what does it mean for margins? Because your branded sales will increase, so ideally it should be margin
Yes.
accretive, right?
Yes,
So,
yes.
so So how should one look at your margin going forward?
If you are talking about EBITDA margin,
Yes.
then if at 70% of branded sales, we are currently stood at 11.5%. So, as per our projection, it will stood between 12 and 12 and 12 to 12.5%.
Which year? FY27? 12 to 12.5%?
FY28. FY28.
In FY28, I mean, when we can reach 80%, right?
Yes.
And what is the differential? I mean, what is your branded revenue margins versus non-branded?
Uh, if you want to know the category wise,
No, no, overall, not category wise, average branded revenue margins versus non-branded.
our majorly EBITDA is came from branded sales only. Margin from non-branded sales is only 4%.
Oh, it's a
So
4%.
entire
Okay, okay.
branded sales is growth driver for margin.
Okay, understood. And given that your both of this unit one and unit two in Jamnagar and Rajkot is at 100% capacity utilization, and your greenfield will come only in the month of September. So, what will drive our growth in the first half of FY27?
Uh, See, as of now, we have a capacity of 6,600 from both of our manufacturing plant. But as you can see that our sales in volume wise more than just a minute. Yes, our branded sales, volumetry sales was more than uh, 6,000 metric ton. So currently we are outsourcing mostly other grocery products and some of blended spices from some other vendors. So after commencing of our new plant, we are able to manufacture these outsourced products from our own unit also. So this will impact in margin. Sales will be as per our target, but the major improvement will be seen in our margin because currently we are outsourcing some of products from third party.
Okay, okay. So, since our capacity is kind of full, so we are outsourcing from other vendor and branding till our
Yeah.
new capacity come, till our new capacity.
Yes. Yes.
Okay, I got. Okay, that would it from my side. I would like to wish you. Just one more thing. Yeah. What's the capex amount for this greenfield?
This new project capex will be around 16 to 17 CR.
Got it. Got it. Okay, okay. That would be from my side. Wish you all.
Yeah. Thank you.
Thank you, Deepak. We'll take the next question from the line of Tanya Kalra. Tanya, you can unmute and go ahead, please.
Um, Thank you for the opportunity, sir. My first question is that the EBITDA margins for FY26 have improved meaningfully. So how much of this improvement is sustainable versus the one-time operating leverage benefits from the Vita Green integration?
No. This is our margin has been improved because we have launched some high margin products in this last financial year. I am pleased to say that last year our other grocery product EBITDA margin was 10%. And this year, this margin has been improved to 12%. because some high value products has been added in grocery products. So and this category is also growing much faster than other categories. So due to this high margin products, our margin has been improved.
Okay, so what is the long-term sustainable EBITDA margin profile for the business?
See, if we achieve 100% of branded sales, then it could be reached up to 15 to 16% is a industry specific EBITDA margin. Like our peer companies are yeah, going enjoying with 15 to 16%. Even some of pan India brands, national brands like MDH, Everest are enjoying with 20 to 25% EBITDA margin because they have only blended spices in their portfolio, and majority sales of their blended spices, sorry, majority sales are coming from blended spices, which is a very high margin category. So if we manage to keep our blended spices category more growing, more growing in entire category, then our margin will be improved significantly.
Okay. So, like so blended spices generally command higher margins, but they require stronger brand pull. So, what investments have been planned in branding and advertising to improve premiumization?
Mostly, we do spend lesser in advertising. We do some region-wise marketing, like we do hoardings, we do brand fascia at our retailer stores. But more majorly, we are focusing to give targeted incentive to our retailers so that they are connected for entire year to our products. So our majority spend of marketing budget is a incentive target based incentive to retailers and distributors.
Okay, sir.
And
One last question.
this is from 4 to 5% of our sales.
Oh, okay, sir. So, one last question. Given the volatility in spice prices, what
Yes.
procurement and inventory strategies help protect the gross margins?
Uh, See, in first question of my answer, I will already explain the our procurement cycle. So this procurement cycle leads us to maintain our profitability throughout the year, as I already explained this in my first question. But if you know, I can again explain to you.
Yes, sir.
Thank you, Tanya. We'll take the next question from the line of Sanchita. Sanchita, you can unmute and go ahead, please. Hello, Ms. Sanchita, are you there? We'll take the next question from the line of Harleen Kaur. Harleen, you can unmute and go ahead, please.
Hello, am I audible?
Yes, yes, you can go ahead.
Good afternoon, sir. So thank you for the opportunity. I have few questions. So my first question is, brown spice capacity has increased to 6,000 metric ton. What is the current utilization level, and by when do you expect optimal utilization?
See, our current utilization has been almost 100% from both of our manufacturing plants. And after commencing of new plant, our capacity will also utilize from 100% because our total volumetric sales was 16,000 ton in last FY26. So if we started our new unit and considering Jamnagar unit combined, we get the 12,000 metric ton of capacity from both the unit. But the last compared to last year volumetric sales, it was 16,000. So after commencing of the new facility, our utilization will be reach 100% in within 1 or 2 months.
Okay, sir. So my next question is the current infrastructure sufficient for the next phase of growth, or should investors expect further capex over the next 2 to 3 years and the 30% CAGR targeted?
Yes, sure. As you know, uh, we are going to establish a Rajkot unit in FY27 with a capex of 16 to 17 crore, and we are also planning to expand our Jamnagar facility by from FY28 or FY29. So after this expansion, we are targeting to achieve 30,000 metric ton of capacity, production capacity from this after expansion of our Jamnagar facility also.
Okay, sir. So my last question is, how scalable is the Rajkot Blend and Spices facility, and what bottlenecks could emerge if growth accelerates faster than we expected?
Rajkot facility is exclusively manufacturing blended and instant mix. As we are procuring third party outsourcing products majority from for Vitagreen brand, 77 brand. So after expansion of our new unit, we will be able to manage this outsourced products from our in-house manufacturing facility. So some of quality concerns we are facing in third party production, and also we are not able to launch some new products due to our manufacturing constraint. So after commencing of new plant, we will be able to launch some new products in blended spices category and other grocery products category also. So this will lead to increase our sales in Vitagreen brand on 77 brand. So hopefully, after commencing of the new facility, we will increase our Vitagreen brand also.
Thank you, Harleen. We'll take the next question from the line of Mr. Viraj Sharma. Viraj, you can unmute and go ahead, please.
Hello, am I audible?
Yes, yes, you are.
Thank you for the opportunity. Sir, since there is 30% CAGR expectation for the next 3 to 5 years, what are
Yes.
the key assumptions behind this? Means volume versus value growth, branded mix, new products, and how will you balance regional strength with national scaling?
Yes. Is our last we are if we are seeing our past growing stage, we mostly focus on capturing the new regions, and with also by getting also help of new products in new regions, like recently we have expanded our sales in northern states. In Jammu Kashmir, if you go to Jammu Kashmir, in Uri region, we have there is only 65 retailers in Uri village, and we acquired 45 retailers, and you can see our 77 double RT brand in 45 of their retailers in Uri village. So this is our uh, uh, base to understand the need of customers. What particular region needs the spice, which kind of spices they want. So we first work on that. We got the samples from particular region. Also, our distributor and our sales channel are helping to acquire the product samples and pricing, etc. Then we develop the particular blend as per the requirement of that particular region. Then only after we appoint the distributors and super stockists in that particular region. This is our SOP to acquire a new region, and this is 100% successful USP to acquire the new region. And this is the reason we are growing in new region day by day. And day by day, we are increasing our retailers' portfolio by acquiring, understanding their needs and providing the particular products to which they need to provide their customers.
Okay, sir. And my next question is on Vitagreen. Means, Vitagreen as a blended spices business is a higher margin business. So, how has the integration progressed so far, and what cross-selling synergies have you realized so far?
Uh, Actually, Vitagreen is definitely a higher margin brand, but the total share of revenue from entire sale is much lower from the double athi in ground spices category. So, like we have 4% of blended spices sales, and less than 5% of total sales in instant mix. So definitely the Double Sun brand is more uh, uh, higher margin category, but a brand, but the category itself is smaller, so it is not reflecting in EBITDA margin. But we are constantly trying to grow this category like blended spices and grocery products. So in coming year, this will also reflected in EBITDA margin also.
Thank you, Viraj. We'll take the next question from the line of Sanchita Sood. Sanchita, you can unmute and go ahead, please.
Yes, hi, am I audible?
Yes,
Yeah.
you're audible.
Hi, so I just wanted to ask that with the Greenfield project that's coming up in Jamnagar in September 2026, what kind of revenues can we expect overall in FY27 and 28?
See, if you are connecting the revenue growth by after commencing of new plant, then somewhat it is not help us to grow our revenue by commencing the new plant, because we are commencing new plant to lower our burden to third party suppliers. So our target in FY27 is 400 crore in consolidated base, and in FY27 it will grow more than 500 crore. But it is not due to the new expansion unit, but definitely we improve our margins and we are able to launch some new products in by commencing of the new plant.
Okay, so at peak utilization, what would be the maximum or potential revenue that we can get on the combined capacity post phase one?
See, as we are considering only own manufacturing plants, then our maximum capacity is 12,000 metric ton. So, in this capacity, we can achieve max to max 300 crore of revenue. but and in some respected season or in particular categories, particular SKUs like ginger garlic paste, asafoetida, we are procuring these products from third party suppliers in our particular packaging. So we are not seeing any constraint for manufacturing capacity to expand, grow our revenue. And also we are planning to expand our Jamnagar unit to more capacity in coming 1 or 2 years.
Okay. Okay. Thank you, sir.
Yeah, thank you.
Thank you, Sanchita. We'll take the next question from the line of Amit Mendale. Shamit, you can unmute and go ahead, please.
Hi, I'm audible now?
Yes.
Great. So my first question is on Jamnagar, the new capex whenever it starts, I think September 26. Uh, for that capex, how is the revenue booked? I mean, is it booked when inventory is sold to distributors or the channel?
No, CapEx is only for capital investment. We are deploying new plant and machineries. We are constructing 42,000 square feet of pub panel insulated shed and some primary and secondary packaging machines, high-tech laboratory. So this capex is only utilizing as a capital investment. But if we are considering debtors and raw material inventory, then it could be different than this capex investment.
No, sir, I'll rephrase my question. So, how I'm asking more from revenue recognition perspective. Like, how is
Yes.
the revenue booked? At what point of time revenue is booked? It is booked when the inventory, whatever is finished product, whenever it is given to the channel, that time the revenue is booked.
Uh, uh, so what are you actually asking for? I'm not understanding exactly.
So basically, I want to understand that, with the new capacity, the 6,000 metric ton capacity that we have,
Yes.
I'm assuming that we will use it to kind of manufacture spices and our products. And,
Yes.
I want to understand when these products are dispatched to the distribution channel.
Okay. Okay.
Will the revenue be booked when
Actually,
it is,
yes. Yes.
yeah,
You can
when
continue.
it is sold to the end customer, or it is booked
Yes.
when the inventory is given to the distributors?
No, actually, when we distribute to distributors, it is booked in our sales. So when it sold to the distributors, then it booked as a sales. But majority of our distributors are taking stock of maximum up to 15 days. So within a 15 days, the stock will be liquidated to retailers.
Okay, understood. And sir, for this, I think we spent about anywhere between 16 to 20 crores. Uh, can you explain, what type of how much was spent for like land and the infrastructure, and how much for actual machines?
Yeah, definitely. The capex is only for plant and machinery. Land is in promoter name, so we are not considering the land value in this capex. We have bifurcation of capex is like 5.5 crore in civil construction in pop panel, while 10 to 11 crore is spending as a new plant and machineries, primary and secondary packaging units, and some of laboratory equipments, office furniture, etc.
Understood, sir. And because as we scale the business, I think we'll require more working capital as well. So when we hit, say, 500 crore revenue, what type of debt do you think we will have by that time? So either that's at 27 and 28, year FY27, FY28, some expected debt levels if you could give.
If you compare our increase of debt in from FY25 to 26, we are our debt is not marginally increased because we have raised warrant conversion from promoters. And in this FY27, we are also received the 11 or 12 crore of warrant conversion from promoters. So this will only utilize for as a expansion and raw inventory and data cycle. So we are in FY27, we are not planning to increase our debt from any financial institution.
So are we saying that for working capital will not take any debt even for 27 and 28 both?
Yes. Yeah, and for our expansion plan, we already taken long-term mortgage loan, long-term term loan from bank, in which is 70% of portion has been shown in FY26. So majority of portion is already deployed. So I think in FY27, no more increase in debt.
Right. So thank you. And my last question is on the FY27. There was a discussion earlier that we can hit about 400 crores of revenue. How confident
Yes.
are we around that number? I mean, or what can be the range? Can it be like 380, 400, 360, 400? What type of ballpark range are we looking at?
No, as per our, as we are continuously increasing our sales team and increasing our distributor channels, we are 100% sure that in FY27 we will definitely cross the 400 crore of revenue. But our main focus is will be on developing our branded sales. So majority sometimes what happens that we are seeing 30% of figure in total revenue. But if you see that we already increased the branded sale by 40%, which is higher than our expectation. So maybe in next year our branded sale will increase by 40 or 45% also. So our main focus is to improve our branded sales. So our margins will also improve and we can
Right. So thank you. And my
uh,
last question is on the blended spices. Could you give that number? How much of revenue generated from blended spices for FY25 and 26 last 2 years?
sure. Last FY27, 25, we generate consolidated revenue from blended spices was almost 7.8 CR. And this year we generated almost 12 CR of revenue from blended spices.
Okay, great. Thank you. That's it from my end.
Thank you.
Thank you, Amit. We'll take a few questions from the chat box. So there is a question from the participant that the company is positioning itself as a dual engine spice FMCG platform after the Vitagine acquisition. So how do you see the revenue mix evolving between ground spices and blended spices over the period of next 3 to 5 years? And which segment structurally offers better margin and scalability?
Uh, as as we are continuously growing our branded sales and category wise, we are seeing ground spices and whole spices will be increased by marginally increased by other categories. Other than other categories, ground spices and whole spices will be increased more. And blended spices is very competitive segment. although there is a higher margin in this category, but there are more than 2,000 of brands are available in Pan India, which are selling blended spices. So we are not focusing on this particular blended category, but we are focusing on high volume category like ground spices and whole spices. We are expecting more than 50 to between 50 to 60% of revenue from these two categories of ground spices and whole spices.
Okay, sir, there is one more question. The company has rapidly expanded distribution from a regional Gujarat-focused brand into 9 states. So, how are you ensuring that the growth remains profitable and not merely channel inventory expansion?
We are not pressurize our channel partners to make the stock at more than 15 days of cycle because we have a large SKUs in our entire portfolio. So if any distributors are keeping only 15 days of stock, then the inventory of their particular distributor is significantly higher from what we expecting. So we are not pressurize our channel partners to stock the material. Although sometimes if we see the price hike in coming period, like in ground spices throughout the year, many times price hike or price decline is openly seeing. So as a time of price hike, we offer our channel partners to stock the ground spices so they can leverage the profit margin in by increasing the price to retail, giving the price hike to retailers also. So I don't think that we are stocking the material at primary channels and not selling to the secondary channel.
Thank you, sir. There's one more question that you have articulated an ambition to capture 1% share of the Indian spices industry. So, what would be the approximate revenue target implied by this, and over what timeline do you believe this is achievable?
We have taken a target by 2030 to achieve this target, and revenue will be around 3,000 to 3,500 crore.
Okay, sir. I think this was the last question for the day. Thank you, sir. The management would like to give any closing comment before we end this conference call.
Yes. Thank you all of members who have joined our investor phone call, and I'm very proud to say that we have currently added more distributors and channel partners in our Madhusudan family. And after commencing of new plant, I will be more happy to invite all of our investors and our channel partners and all our well-wishers to visit our newly opened plant and see what kind of technology we are deploying in our new plant. Some of first kind of manufacturing process is deploying in our new plant. So we will be very happy when, as and when we are going to going to deploy the new plant. I will invite all the investors and our well-wishers to come and see our plant. That is all from my side, and thank you for always supporting our company. Thank you so much.
Thank you, sir. Thank you to the management team for giving us their time. Thank you to all the participants for joining us on the call. This brings us to the end of the today's conference call. You may all disconnect now. Thank you.